So I'm going to start with tariff news. How trade negotiations end up will be crucial in determining the future of the economy. President Trump threatened Switzerland with 39% tariffs that would go into effect on August 7th. This week, Apple upped its announced investments in the U.S. to a total of $600 billion. And earnings season continued. Apollo. Private equity is having some issues these days. The Gartner Group's earnings is one of the more important earnings reports for this season. It shows that AI is starting to have some negative impacts on the tech sector, but I can't emphasize this enough. Hi, this is Steve Eisman, and welcome to another weekly wrap. Today's wrap is coming to you from the road, so the sound, the visuals may not be up to our usual standards, but it's in a very important period of time now, so I thought I would do this anyway from the road. So I'm going to start with tariff news, only because how trade negotiations end up will be crucial in determining the future of the economy. First up is Switzerland. Last week, President Trump threatened Switzerland with 39% tariffs that would go into effect on August 7th. On Monday, the Swiss government announced that they were making a better trade offer. Stay tuned. Last week, President Trump also threatened India with 25% tariffs plus unspecified penalties as well. President Trump expressed particular displeasure with the fact that India buys the bulk of its oil from Russia. Unlike Switzerland, Prime Minister Modi expressed no desire to cave. Quite the contrary. So on Wednesday of this week, President Trump raised the tariffs from 25% to 50%. President Trump also made clear he wants pharmaceutical manufacturing to return to the U.S. He said he would put light tariffs on pharma imports, but only to give pharma time to build factories in the United States. But that in a year and a half, he would raise those tariffs to 150% and then 250%. And on Wednesday, President Trump also announced that he would impose 100% tariffs on semiconductors, but would waive those tariffs if a semiconductor company built factories in the United States. Also, Apple promised to invest another $100 billion in manufacturing in the U.S. beyond what it had already promised. I'll talk about that more in a bit. Now, before we move to earnings, let me sum up what I think is happening with respect to tariffs. According to Dan Clifton of Strategas, my go-to guy on tariffs, the effective total tariff rate will probably reach 13 to 14%, not the 19% being bandied about in the press. High, but not as high as some fear. On a more granular level, despite the rhetoric around Canada and Mexico, and I can't emphasize this enough, most of the trade between Canada, Mexico, and the United States is exempt under the prior treaties signed with President Trump in his first term. This means that despite the headlines, the effective tariff rate is much lower than the headlines. According to, again, Dan Clifton of Strategas, my go-to guy, for Canada, the effective rate, and this is after you exclude all the stuff that is excluded under prior treaties, is only around 3%. For Mexico, it is 9%, but Mexico has 90 days to negotiate that down. This gives Canada and Mexico a significant advantage and could be by design to bring supply chains back, not just to the US, but to North America. The UK and Australia got 10% tariffs. The EU, Japan, and South Korea got 15%. Tariff rates go higher in Asia, ex-Japan and South Korea, with Asian countries that are involved with transshipping China's goods to the U.S. at 16 to 20% at least, and in the case of transshipping, much higher. And the BRIC countries, here, Brazil and India are the most important, got 50%. It is possible that Brazil and India have been singled out partially because they are pushing for alternatives to the dollar. The last thing I have to say about tariffs is that some companies have rushed to make announcements about making investments in the United States so they can avoid tariffs, and President Trump seems to just take those announcements at face value, when more skepticism might be appropriate. Take Apple, which I discussed before. This week, Apple upped its announced investments in the U.S. by $100 billion to a total of $600 billion, and promised to spend that $600 billion over 4 years, so $150 billion per year. Patrick McGee, the author of Apple in China, who I interviewed a few months ago, points out the following on his Twitter account. Apple invests $55 billion a year in China, where it makes 90% of its products. He expressed skepticism that Apple could physically invest $150 billion per year in the United States, and many sell-side analysts who cover Apple expressed similar skepticism. And earnings season continued. First up, Palantir. Company reported after the close Monday. Quarterly sales reached $1 billion for the first time and grew 47%. Impressive. EPS was 16 cents versus 6 cents, and versus the consensus of 14 cents. The company raised guidance, and Palantir is a software company that integrates and analyzes big data for governments and corporations. In the United States, commercial revenue was $306 million, and U.S. government revenue was $426 million. I flag these numbers only because there is a limit to how much research anyone can do with respect to Palantir. Of that $426 million, most of it is with the Defense Department and the CIA doing secretive stuff. It's not like you can call them up and ask the department or the CIA just how Palantir is doing and how many more contracts they're going to get. But Palantir is without question growing like crazy. The CEO is predicting that the company will grow tenfold in the next 5 years. Amazing if that happens. The 2025 PE is 281 times earnings, and the price to revenue is 106 times, which just goes to show that in good times, investors care more about stories than current valuation. On Tuesday, Palantir was up 8%, and for the year, the stock is up over 120%. Palantir now has a market cap of around $420 billion. Next up, Caterpillar. In the recently passed budget bill, there is a provision that allows companies building factories to write off the entire cost from their taxes. If that provision creates a construction boom in the U.S., Caterpillar is sure to benefit, and that is why the stock is up double-digit percentages this year. But those benefits are not yet here. Earnings per share was $4.72, down versus $5.99 last year, and it was also a miss versus the consensus of $4.88. The company projected a net impact from tariffs of $1.3 to $1.5 billion, and the miss was slightly weaker prices. But despite the miss, CAT was not down that much because investors still hope for that construction boom. Apollo, the private equity firm. Private equity is having some issues these days. The IPO market is still weak, although that could be changing, but this has meant slow monetization. Some institutional investors have lost patience and are seeking exits. But Apollo, while technically a private equity firm, is much more a private lender. And that growth story continues. The company reported strong second quarter numbers, with the beat coming from fee-related revenues rather than investment gains, which is what investors pay for. And the company had $61 billion in inflows for the quarter, very powerful and better than expected. The stock rallied around 2% on those numbers. Vertex, a biotech company. Now, I'm the first to admit that biotech is not part of my expertise. But I flagged Vertex because the company reported on Tuesday and the stock was down a whopping 20%. Why? It was not the revenue or earnings. Those were fine. It was because one of Vertex's key future drugs was a pain management drug. And the company announced that the drug had failed crucial tests and Vertex would no longer be pursuing it. This just goes to show that when it comes to pharma and biotech, what happens to the drug pipeline can be much more important than current earnings. Eaton, an industrial company. This has been one of the best performing industrial companies for years now. It's in the electrification space, which means, amongst other things, that the boom in data center construction benefits Eaton. Probably around 25% of Eaton's business is data center related. The only industrial company which is higher is the cooling company Vertiv at 80%. That is why Eaton wields a very high PE of around 30 times 2025 estimates. But with a multiple like that, you cannot disappoint. And disappoint, Eaton did. The company reported earnings per share of $2.95 versus $2.73, which beat estimates, but it guided third quarter earnings per share to $3.01 to $3.07 when the consensus is $3.09. This was not your typical beat and raise quarter from Eaton, and as a result, the stock was down over 7% on Tuesday. Next up, Gartner Group. This is an $18 billion market cap company providing research and consulting in the tech space. It's a well-run company that some investors have owned for years because it wields an incredible franchise. But sometimes, moats around businesses erode. It grew earnings per share by 24% in 2024, but EPS is estimated to be down by 16% this year. Why? Two reasons. First, the U.S. government is cutting back on consulting contracts, and that is hurting companies like Gartner and Accenture. But there is also something else extremely important that is probably beginning to occur. It looks like companies are finding they can get information and analysis for free by using AI, and therefore don't have to pay Gartner for services they would have used Gartner for in the past. So revenue for this quarter was up only 4.9%, and earnings per share was up 10%, but the guidance was poor. The company is guiding to 2025 to 1175, while the consensus is 1250. The stock was down, get this, 28% on Tuesday. Wow. In some ways, the Gartner Group's earnings is one of the more important earnings reports for this season. It shows that AI is starting to have some negative impacts on the tech sector, or at least parts of the tech sector. Here, tech consulting. We will see how much it impacts Accenture when it reports, but it could have negative implication for parts of the software sector as well. This is a big theme that is just beginning to unfold, which we will be exploring in future podcasts. AMD. The stock is up nicely this year, but is only getting back to where it was in early 2024. AMD is a chief, but smaller competitor to Nvidia. Revenue increases by 32%, and earnings per share met expectations. But the stock declined 5% on Wednesday. Why? Two reasons. First, the all-important AI data center GPU revenue disappointed, which means AMD is not catching up to Nvidia, and the company was unable to give a clear outlook for resuming sales in China. Next, Supermicro is one of those derivative AI plays. Now, the company makes servers which are needed for data centers, so that's good, and it competes with Dell. But what it and Dell sell are mostly not proprietary tech, unlike, say, Nvidia's chips. Also, last year, Supermicro had issues with its auditors, and that has hurt its reputation. The company reported results that were below expectations, and its September quarter forecast was disappointing, both in terms of earnings per share and revenue. And on Wednesday, the stock got rocked and was down 18%. On the other hand, Arista Networks, ANET. This is an AI-related play too, but with products that are far more proprietary than Supermicro. ANET competes with Cisco and provides various kinds of connectors that connect the servers in data centers to other servers or to the outside world. It provides other products that allow data centers to function like monitoring technology. The huge growth in data centers provides a big benefit to the company, and this showed in its June quarter. Revenue grew by a very strong 30%, and earnings per share was up even more by 39%. It was another beat. And the company raised guidance by 7% and 2026 earnings per share guidance by 4%. And Arista committed to double-digit revenue growth beyond 2025. The stock was up 17% on Wednesday. Wow. Rockwell. Now, here's another industrial company, but in the automation space, as opposed to electrification. Prior to Wednesday, the stock was up double digits as investors looked at the company as a beneficiary of the new budget law. And in that law, companies can write off the entire cost of building a factory from their taxes. Any new factory requires the automation devices manufactured by Rockwell. However, that is the future. The company reported $2.82 versus $2.71 and versus the estimate of $2.66. So far, so good. Sales were up 4.6%, which was also a slight beat. But the company narrowed guidance where the middle of the range is $9.70 and the consensus is $9.83. Clearly, investors were hoping for much more, and the stock was down 5%. Emerson is an industrial electrification company, but its investor theme is very similar to Rockwell. The company reported $1.52 versus $1.43, which was a slight beat, but revenue was lower than expected, and it guided the September quarter to below the consensus. The stock was down 10% on Wednesday. The disappointing guidance from Rockwell and Emerson show that the positive implications from the budget bill have not yet hit. Disney reported fiscal third quarter that beat expectations but missed on the revenue side because of its linear businesses in media. The guidance, while a raise, was a disappointment to the bulls. Disney is number 2 behind Netflix, but it is weighed down by its legacy businesses such that total revenue grew only 2%. Disney's stock reached a peak of $200 in 2021 as investors focused solely on the growth in streaming. But now reality has set in and how difficult it is to manage a declining legacy business with a growing parks and streaming business. The stock was down 2.5% on Wednesday. Shopify, an e-commerce company. Shopify soared 21% on Wednesday. Earnings per share beat, but revenue actually missed expectations. But the company said it expects revenue to grow mid to high 20s percentage rate. Shop was a really hot stock during COVID as consumers were forced to buy everything online. Then, when the world reopened, Shop's revenue growth slowed very dramatically, and the stock dropped to below $30 in 2022. Clearly, business is back on pace as the stock closed above 150 on Wednesday. Eli Lilly. Lilly seems to be winning the weight loss drug wars as Zepbound, Lilly's drug, accounts for 60% of branded weight loss prescriptions in the United States, while Novo Nordisk's Wegovy is at 40%. Lilly reported great quarterly earnings, beating expectations, and it raised both revenue and EPS guidance. So what did the stock do? It went down 14%. Why? Because in pharma and biotech land, like I said, the pipeline is all important. And Lilly also reported data for its daily obesity pill, which is still being tested. It showed results that the patients lost 12% of their body weight after 72 weeks of usage, but investors were hoping for weight loss of 15% plus, and that disappointment caused a decline in the stock. And the last company we'll talk about is Opendoor. Now, this company reported, normally I would not discuss a $1.5 billion market cap company, but I have discussed this company because it has become a meme stock. What does it do? It buys homes and resells them. I have no position in this stocks, but I think it is just a bad business. Zillow tried it and it almost sunk the company, and they exited just in time. It's a balance sheet intensive business. The stock was 50 cents in June. Then a hedge fund manager went on social media arguing the stock was worth at least $40, and the stock got as high as $3. The company's June quarter revenue was $1.6 billion, up 4%, and it reported a slight net loss. But management stated that the housing environment is poor and guided revenue to less than $900 million for the September quarter. The stock was down over 20% on Wednesday and is now back below $2. And that's the wrap. I'm not going to do any mailbag this week because I'm saving your questions for the end of this month when I do a podcast dedicated to answering all of your questions. This last Monday, we dropped a podcast where I interviewed Stu Eisman of RRE Ventures, a venture capital investment firm. Now, both private equity and venture capital are broadening their investment bases from institutional to retail. So for those of you who are interested in venture capital, this interview, I think, is quite educational. Venture capital has certainly created some amazing companies, and we discussed that. But what is less well known is that in 2022, venture capital suffered a depression from which it has not completely emerged. Valuations got obliterated. Many funds will go out of business, and today VC is bifurcated. There are great investment opportunities in AI, crypto, and blockchain, but outside of that, VC has not come back, and VC accounting allows firms to sometimes hide their problems. So if you have interest in VC, I'd recommend you listen to that interview. This coming Monday, I'm going to do something a bit different. Instead of me interviewing a guest, my guest is going to interview me. For this, I needed a serious professional, and so my guest is Melissa Lee of CNBC. Our discussion is wide-ranging, from my history as a sell-side analyst in the 1990s to the financial crisis to my current views of investing and the market. Hope you tune in. And if you haven't already, please consider subscribing to our YouTube channel so you can receive these weekly wraps along with our podcast and the financial literacy masterclasses, which we will be releasing soon. Subscribing is the best way to help the channel, and we greatly appreciate your support. Thanks for tuning in. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.